So we have talked about allowable and non-allowable expenses. And today, we will talk about basis of assessments.
Yes, we did.
Okay, good. So that means we are moving to, and we've okay, yes, that's true. So I've talked about that. Okay, so the next one is accessible profits. Now, for our accessible profits is different from the way we compute our accessible profit under company's income tax. Under company's income tax, your accessible profit is equal to your adjusted profits. But under hydrocarbon tax, your accessible profit is not the same as accessible profit. Your accessible profit is equal to adjusted profits less loss that the company had incurred. That is how you calculate your accessible profits. Now, how do you treat loss under hydrocarbon tax? The loss in a previous accounting period can be brought forward to the for the current year. So you can bring your loss forward just like the normal thing we do under company's income tax. For a new company, the amount of loss incurred during its first accounting period in a trade. So for an existing company, the loss of a previous period, you are bringing it forward. For a new company, the entire loss you incur in the current year, you are deducting it. Losses that cannot be carried forward that cannot be fully deducted in any one period can be carried forward for the next succeeding period until it is fully relieved. Now, there's another provision in the tax law that talks about deferment of losses. Under the company income tax laws, you cannot defer your loss, but here you can defer your loss for a maximum period of 5 months within the accounting period. And this must have been, we must have informed the tax authority about deferment of your loss. Okay, so that is that. Any deferral will not be deducted in the subsequent year unless an election is made. So if you are deferring your loss, you must have it in writing within the next 5 months in the accounting period. And if this is the case, your loss will not be deducted because you have said that you want it to be deferred. So that is that. Now, the next one that we're going to be talking about is your chargeable profit. What is the chargeable profit? You remember when we're doing our company's income tax, we talked about total profit. Total profit will be your aggregate income less your loss to live less your capital allowance. Now, for chargeable profit, your chargeable profit in this instance is your accessible profit less capital allowance according to Schedule 6 of Companies Income Tax Act and according to Section 266 of the Act. Now, what are we trying to talk about here? We have what we call production allowance. And we also have what we call your capital allowance. Now, so these are to be put into consideration when you are computing your chargeable profit. The first to consider when you are considering your chargeable profit is your capital allowance. You deduct capital allowance, and you would also deduct your production allowance. You also deduct your production allowance. So let's talk about capital allowance in brief. Now, you all know what capital allowance is. What is capital allowance? Capital allowance is allowance granted to a taxpayer that has incurred qualifying capital expenditure and put to production use at the end of the basis period. So for companies in oil and gas, their qualifying capital expenditure are restricted to 5 categories. The first one is plant, machinery, or features. The next one is pipeline and storage tank. The next one is construction of building, structure, or works of permanent nature. The next one is qualifying drilling expenditure incurred, tangible or intangible, and acquisition of rights in or over petroleum deposits is also categorized as qualifying capital expenditure. Now, there could be a situation whereby asset is used partly for petroleum operation. When an asset is used for partly petroleum operation, the part that was used for petroleum operation relief will be granted on it. The one that was not part of it, that was used for maybe private use, will be excluded from the computation of your capital allowance. So that is that. Now, for the purpose of petroleum operations, we will be talking about two types of allowances. The first one that we're going to talk about is the annual allowance, and the next one is production allowance. So we shall continue to talk about that as we go ahead now. Now, annual allowance. You remember when we were doing our company's income tax, we said we'll have hold on, guys. Okay, guys, I am teaching hydrocarbon tax. I'm continuing from where I stopped in the last class. I am continuing from where I stopped in the last class. Okay? All right, let's go ahead. So, as I said the other time, I said for the purpose of petroleum or profit tax, or for petroleum hydrocarbon tax, we have two types of allowance that we're going to be looking at. The first one is petroleum allowance, and the second one is annual allowance. The second one is annual allowance. For our annual allowance is computed for a period of 5 years. By implication, our tax rate, our allowance rate is 20%. Our allowance rate is what? 20%, which is going to be what? Granted to the taxpayer when the taxpayer incurs qualifying capital expenditure. When the taxpayer incurs qualifying capital expenditure, the taxpayer is expected to claim 20% each year. Now, you remember we talked about tax written down value, and we talked about nominal or residual value under company's income tax. In your company's income tax, we said the taxpayer shall retain nothing more than 10 naira. The taxpayer shall retain 10 naira in your, what's it called? In your assets. So when you have an asset, the taxpayer will retain 10 naira. That is what we said. You must retain 10 naira when you have an asset that is in your book. So that means you will not dispose all the assets. All the assets will not be disposed. You must have a written down value of 10 naira in your book. That is what we said when we talked about your company's income tax. But under hydrocarbon tax, you must retain a value of 1% of the qualifying capital expenditure. So imagine your qualifying capital expenditure is 10 naira. Sorry, it's 100 million. At the end of the 50th year, you must retain 1% of the assets. You must retain 1% of the qualifying capital expenditure. That's what we are trying to say. In your company's income tax, you are retaining 10 naira. Under hydrocarbon tax, you are not retaining 10 naira. You are retaining 1%. That means the assets in question here has a useful life of 5 years. Unlike your company's income tax that could have various useful life, in this regard, the asset life is 5 years. Under your company income tax, furniture and fitting, we have 5 years. Plant and machinery, we have 4 years. Building, we have 10 years as the years in which you can claim allowance. Under your hydrocarbon tax, all the assets that the company has will be used for, assumption is that it's supposed to be used for 5 years, and capital allowance will be calculated at the rate of 20% of all these assets that you have used. So invariably, we are saying the maximum of 5 years is what the assets we use. You have any question? So again, we talked about the first and second appraisal well, and we talked about the first exploration well. Now, the first exploration well will also be what? Will be capitalized. And the first 2 appraisal well will be expense, while the next 2 appraisal well will be what? Will be treated as capital expenditure. Do you understand me? So what we are trying to say here is that the first 2 appraisal well will be expense. Anything after the first 2 appraisal well will be capitalized. And in the process of capitalizing it, you must also compute annual allowance on it. Do you understand? So that is that. We move on to the next one. Now let's see how we calculate our qualifying capital expenditure. How do we calculate it? You have the study pack with you, right? Hello,
Yes,
guys.
sir. Yes, sir, we have.
Yes, sir, we have.
Good. Please follow me. I'm on page. Okay, this is not paged, but I'm on where we have qualifying capital expenditure and acquisition cost rights, acquisition cost of petroleum rights. And I just moved to illustration 1 now. Illustration 1. Now, for this illustration 1, we have various types of assets that we are given. And we are given the year the company is. The company is currently in 2023, but we are given the assets acquired by the company. And the examiner now said, compute the annual allowance for 2023 year of assessment. Now, when you are computing the annual allowance for 2023 year of assessment, you remember I told you that each of the qualifying capital expenditure will use 5 years. So we need to start looking at it one after the other. Now, if I acquire an asset in 2019 and I'm in 2023, in 2019, that asset would have claimed annual allowance on it. Abi, that is year 1. In year 2, which is year 2002, year 2020, we would have computed annual allowance on it. Abi, would have on it. That is how many years? 3 years. In year 2023, that asset that we acquired in 2019 would have been used for 4 years before that year. That means in 2023, the asset that we acquired in 2019 will have gotten to the 5th year, right? So that means in the last year of use of this asset, we must say the assets will be used for a proportion of it. It's not going to have 20% again. Rather, it will have 19%. I'll say it again. I said in the first 5 years, the asset is supposed to use 5 years. Meanwhile, in the last year of use, that is the 5th year, the annual allowance should be 19%. The annual allowance should be 19%. Look at it. So if you go back to where we have the table for annual allowance, we have 1st year, 2nd year, 3rd year, 4th year, and in the 5th year, you see that it is 19%. Meanwhile, we said the retention value will be what? Will be 1%. And before you can dispose your assets, that you must inform the relevant authority. Okay? So 19% is what we're going to have. So we are saying the asset that we acquired in 2019 at the point of 2023, that asset will be, our annual allowance on that asset will be 19%, not 20%. Do you understand me? Do you understand me?
Yes, sir.
Because why is it 19%? It is 19% because the asset has used 4 years before now. And in 2023, that is the 5th year. Because that is the 5th year, the assets in question will be, we're going to calculate annual allowance for it, which is going to be at the rate of 19% in the 5th year. Now, the second one is tangible drilling cost that was acquired in 2020. In 2023, the asset would have used 2020, 21, 22, 23, 4 years. So in that year, the capital allowance rate that we're going to compose is going to be 20%. It's going to be 20%. The next one is pipeline. Pipeline was acquired in 2022. That means it has only used 2022, and in 2023, we are going to calculate 20% of that. Abi? The next one is building. Building was acquired in 2023, which is the current year. So our annual allowance should be 20%. If you do not understand this, please let me know. Do you have any question? Do you have any question? Okay. In the absence of no question, we can move ahead. So the next thing that we're going to be looking at now is the illustration 2. ABC Limited first made a sales of chargeable oil on 1st of January 2018 under the program of continuous production and sales. As of 1st January 2023, the company acquired qualifying plants expenditure for 50 million. Between 1st February 2023 and 31st December 2023, additional acquisition was made on plant and machinery, which cost 60 million. You are required to determine the residual value of the company assets of the company after 2027-year accounting period. What will be the residual value? Now, the first asset that was acquired in 2018, right? In 2018. Sorry, the first asset that was acquired in 2023, January, right? It was acquired in January. The second one was acquired within the year. So that means the total acquisition that the company made in 2023 was 110. 60 million plus 50 million. That was the asset acquired that year. Now, in the first year, which we acquired the assets, we are going to calculate 20% of the assets. Abi? So 20% of 110 will be 22 million, right? So our residual value carry forward will be 88 million. In 2024, our annual allowance will be 22% again, 22,000 again, that is on the cost. We are calculating it on the cost. 22,000. 2025, which is the third year, 22,000. 2026, which is the fourth year, 22,000. 2027, which is the last year of use, it is going to be 19,000. 19% rather. 19% of the cost. And 19% of the cost will give us 20,900,000. 20,900,000. And at the end of the day, we are going to have 1,100,000 as our retention value. Because you remember, 1% will be what? Will be retained. And before you can dispose these assets, you must get the consent of the relevant authority. Now, the relevant authority here is a commission or any other person authorized by it. Do you have any question? Any question? In the absence of none, we move on to the next one. When an asset is disposed, what happens? You know the treatment of our disposal. It is either the company has what we call balancing charge or balancing allowance. Balancing charge will arise where a company sales proceed is more than the tax written down value at disposal. And the next one is balancing allowance, where the sales proceed is less than the assets, is less than the tax written down value of the assets, where the sales proceed is less than the tax written down value of the assets. So that is that. So we'll move on. What is the treatment of assets acquired prior to the date of commencement? Number one, any asset acquired and put into production use prior to the date of commencement will be deemed to have been acquired at the date of commencement. That is the provision of the Act. Now, what about when you acquire an asset and dispose it before the commencement? Capital gains tax will be paid on the assets. When you acquire an asset and dispose it before the commencement of business and you make loss, such loss shall not be allowed during the commencement of the business. So the next one that we're going to be talking about is provisions of production allowance. What is the Act saying? Section Schedule 6 of this Act talks about production allowance. So this is basing our production allowance on what the company produce. And that is what we are going to use to compute our allowance. So the Act is saying that for conversion contracts, that is contract that moves from petroleum profit tax to hydrocarbon tax. You know, that means you've been in business for so many years, right? Now we are saying that their production allowance shall be lower of 2.5 cents dollar, $2.50 per barrel, on 20% of fiscal value of oil. What we are trying to say here is that our fiscal value of oil, 20% of it will be compared to 2.5%, $2.50 per barrel, and see the one that is lower. The one that is lower is what the Act is going to allow. Okay, we allow that as production allowance. As production allowance. The next one for onshore contracts. For onshore area, So in any question, the examiner will tell you the kind of location or the kind of area in which this company operates. They will tell you. So for an onshore location, what would happen? For an onshore location, the production allowance will be lower of $8 per barrel and 20% of fiscal oil price, up to a cumulative maximum production of 50 million barrels from commencement of production, and lower of 4%, $4 per barrel, and 20% of fiscal price thereafter. So what we're trying to say here is that cumulatively to 50 million barrels, we are going to calculate lower of $8 per barrel and 20% of fiscal price, lower of the two, we get that value, plus any excess that the company produces that is in excess of 50 million barrels. So at that excess, we're now going to calculate lower of $4 per barrel and 20% of fiscal price. That's what we are saying. For shallow waters, the same thing, except for the fact that the cumulative year is 100 million barrels. Any excess will be done in the similar manner. For deep water offshore, so we are considering maximum of 500 million barrels and $4 per barrel. So any excess of 500 million barrels, the company will be subject to tax. So sorry, we get an allowance of lower of $4 per barrel and 20% of fiscal price thereafter. So let's go and look at computation. Illustration number 3. We talk about it. Yes.
So please, I didn't understand this production allowance. Can you explain?
Let's go to calculation. You will see it now.
Okay.
Can you read illustration 3 for me, Favor? Are you reading it?
Let me read this, sir.
Okay, go ahead.
Pillar Oil Upstream Petroleum Company Limited was established several years ago, and the following data for crude oil production for the year ended 31st December 2023 is provided in the schedule below. So we have the area of operations, onshore, shallow waters, and deep offshore. We have their prior year's cumulative production, giving us in barrels, current year production in barrels, and we have the total cumulative production, right, which is a prior plus current. Now they now say, it should be noted that the fiscal oil price advised by the Nigerian Upstream Petroleum Regulatory Commission, NUPRC, is $125 per barrel, and B, that the company disposed all the crude produced in the current year at the fiscal oil price advised by the Commission, and that we are required that A, compute the fiscal oil value of crude oil sold for 2023 year of assessments, and B, compute the production allowance for 2023 year of assessments. Thank you.
Thank you. So they want to compute fiscal value of crude oil sold for 2023 year of assessment, which is the current year, right? So for the onshore, I'll just say the value, that is 7.5 million multiplied by $125. Abi, that is the value. That is the value. So for the second one, it is going to be 35 million, 7.75 multiplied by 125. The last one will be for the 7.2 multiplied by 125. You have your answer there. So that is what the examiner wants to compute. Any question? Now, let's now go to how to compute the production allowance. You remember, I told you area of operation is very necessary. The first one is onshore. For an onshore area, we said cumulative maximum of how much? 50 million barrels. So we'll first say up to 50 million barrels at $8 per barrel. That is what he has said. He said $8. And 20% of the fiscal price of the crude oil. Abi? Now our fiscal price of the crude oil is $125 multiplied by 50 million barrels multiplied by 20%. The lower of the two is what we are going to take. So when you multiply 50 million multiplied by $8 per barrel, you have $400 million. When you do that for 125,000 barrels multiplied by 20%, you have 125 million, $1.25 billion dollars. So the assets, you take lower of the two. That's the first phrase. Okay, you remember the phrase. The production allowance will be lower of $8 per barrel and 20% of fiscal price up to cumulative maximum of 50 million barrels from commencement of production. And that and is talking about the excess of 50 million. Now, when you look at this guy, the total production of this guy cumulatively was 60,500,000 barrels, right? So what is the excess of that? That is 60,500,000 minus 50 million barrels will be 10,500,000, right? That 10,500,000 barrels produced will be multiplied at the rate of $4 a barrel, lower of $4 per barrel, and 20% of the fiscal price of the excess. So we have calculated that there. We have 42 million and 262,500,000. The lower of the two again will be taken. That is 42 million. So if you add these two together, we have 442 million. That is what this guy will claim as production allowance in 2023. Do you understand? Now, a question will come to your mind. And that question too is also bothering me as I'm teaching you this topic. That's what happens in the second year. So my assumption in this question would have been that before now, this company had not computed production allowance before. They've not claimed production allowance. Do you understand me? That means in the subsequent years, I'm saying that again. My assumption in this question is that this company has not claimed production allowance before. That means in the subsequent year, what would have happened in the subsequent year is that we are only going to be doing it on on the excess of the 50 million. On the excess of whatsoever the company are taking. If the company is an onshore company, that their production is onshore. So that means, let's say we get to 2024 now, and they said we should also compute their production allowance. We will not go to this one again. So we have computed on the 50 billion in the first instance. We have concluded on the, what's it called, on that excess in the first year. So going forward in 2024, what I'm going to be calculating on will be based only on the current year. So what we are doing here is that this company had never taken production allowance before. Okay? So now that they have taken production allowance in 2023, in 2024, you are not going to be doing this cumulative now, because we have known that this company has taken that cumulative up to 50 million. They've taken it. So what we are going to be doing going forward is that in 2024, what we are going to calculate as their production allowance will be the current year production. And at that instance, we are going to be using $4 and 25 and 20% of the fiscal oil price. Whichever is lower is what we are going to take going forward. Do you understand me?
Come again, sorry.
All right, I'll come again. This is what I'm saying. I am saying that the assumption in this question is that this company had never taken production allowance. Okay? I'm going to put it in my subsequent edition that this company had never taken production allowance. So this is the first time that they want to take this production allowance. So this is the position as of the first time ever the company wants to take production allowance. Now, in the subsequent years, where they have taken more than this 25% cumulative, more than this 50 million cumulative, what we are going to be doing is that in the subsequent years, we are going to focus only on the lower of the excess of 50 million barrels. That is the current year production. So let's assume, what we have done here is that the cumulative production for this year to this year is 60 million. And we have computed the first 50 million and the balance, which is 10,500,000. Now, let's assume we go to 2024. In 2024, you cannot take allowance again on what you have taken allowance on before. So you are only going to focus on the current year. And that current year, the premium that will be applicable to you is the excess of 50 million barrels. And in that instance, when you are going to calculate your value, you are going to use the $4 and the $4, not the $8 again. And lower of the $4 and 20% of the fiscal price. I need to come start to get myself access.
Can you use this illustration to?
Yeah, that's what let me so that when so let's say in 2024, okay, good. Okay. Let's assume that the 2024 production was 8 million barrels. So what I am now saying is that you are not going to compute for this 50 million barrels thing again. What you are going to do is just to take the lower of $4 per barrels and 8 million barrels multiplied by $125 multiplied by 20%. The lower of the two is what you are going to take in the current year. Let me come and see. I need my screen now. I don't know why it's not picking. Just hold on. Can you see my screen?
Yes, sir.
Good. This is what I'm saying. When you look at this first one, I am saying that let us assume, this question is based on the fact that this company had never taken this allowance before. And that was why we said we are composing it on 50 million barrels for the first time. Anything in excess of 50 million barrels will be at the allowance will be $4 per barrel. Abi?
Yes.
Lower of the two will be 42 million. Abi? And the lower of this one will be 40 million, 400 million. So we're now saying, let us also assume that this company in the subsequent year, let's say in 2024, they produce 8 million barrels. We will not go back to this one. We will not go back to this guy. We will not go back there. We will not go back to. Can you see my mouse?
Yes.
We will not go back to this 50 million and the X. We have done that in the first year. So what we're now going to do now is to say that 8 million that you produce in the current year, let's say they put current year 2024 year. So that 8 million that you produce in the current year will be so you are going to now use this second cumulative for it, this second basis for it. Because in the first instance, we have taken advantage of this 50 million. So we are not going to do it every year. Say, first 50 million. No, we have done that before. Because the reason why we have done it this way is because this is a new provision. And this company had never taken advantage of this provision before. They can take advantage of that. But subsequently, because they are taking advantage of it in the past, they will not take advantage of it in the current year again. Do you understand? So we now say 8 million barrels multiplied by $4. Lower of, so now the next one is 8 million barrels multiplied by $125 at 20%. So the lower of the two is what we are going to have for that current year. So that is that. So let us assume again that this company is on shallow water. For shallow water, you remember, we said cumulative to 100 million in the first year, 100 million. And any excess of 100 million will be subject to tax, will be at rate of 4 naira per barrels and lower of the excess. So we have said, when you look at that, first 100 million, we have this. What's the total cumulative that this company had is 125. Abi? So first 100, we have done this. We have done this. Now, the balance, which is 125, which is 25 million, will be at the rate of $4 and lower of 125 at 20%. So you take lower of these two again and add it to this and this to get this. Do you understand me? To get this. Thank you. Any question? The same
So,
thing.
sir, how do we know that the company has not computed production allowance for the first time for us to use this second format? You just stated now. That's for us to use this in
The examiner
2024.
will let you know
Mm,
that the company has been existing for so many years.
okay.
That regard, but what examiner has been doing is that examiner has always gave these numbers. They will not ask you to compute it. They would have always given you. I'm just telling you the basis for computation. Do you understand?
Yes, sir.
Examiner would have given you. The next one that is very important for this is cost price ratio. Is cost price ratio. This is very important also for us to know. What is the effect of cost price ratio? Cost price ratio is used as a benchmark. It's used as a benchmark for the company so that you will not take more than what you are supposed to have taken, so that the government too can also have something to take from your profit. So the deductible costs before computing hydrocarbon tax shall be capped at 65% of gross revenue at measuring points. This includes the following: all operating costs and capital allowance. Now, how do you calculate your operating cost for cost price ratio, for example? Your operating cost is your total operating cost, except for the following. Number one, rent. Rent incurred to a petroleum mining lease or petroleum prospecting license. That rent, any amount you pay as rent, is excluded from your operating expenses for the purpose of computing cost price ratio. Royalty is excluded. Contribution to any fund, scheme, or arrangement approved by the commission. Host community development is excluded. Environmental remediation fund is excluded. Niger Delta Development Commission for is excluded. Any similar contribution is excluded, and production allowance are not also subject to CPR limit. So these are the exemption from your expenses. You will not include all this. So what we are trying to say here is that when you get your total expenses, you subtract all these non-allowable for the purpose of CPR from it. Then you will now compare with 65% of your gross revenue. You compare with 65% of the gross revenue. You compare with 5% of gross revenue. At that instance, what we are now saying is that your revenue, your amount that will be subject to tax cannot be more than 65% of your revenue. Let's go. That's what we are saying. Let me go and show you where that was calculated. So look at this. When you look at my computation of my CPR ratio, I said my gross revenue, we have gross revenue on top, a maximum allowable deduction, maximum allowable for CPR is capped at 65% of revenue. So my total operating expenses, add back capital allowance, less the following, less everything. So this is your adjusted total OPEX for CPR. At the end of the day, we are going to compare this plus this one plus this. This thing is distracting me. Can you see my screen? Okay, good. I am saying for you to compute your CPR, it is going to be your gross revenue, you cap to 65%. That means your total expenses that we want shall not be more than 65% of your gross revenue. But in the process of doing that, we also need to compute our adjusted total revenue for CPR limit. So we are going to compare these two. We are comparing this adjusted revenue, adjusted total revenue, adjusted OPEX, and we're also comparing with this 65%, whichever is higher. So now allowable cost for OPEX comparison shall be lower of the two. So it shall be lower of this, either this or this. Anyone that is lower is what you are going to use for your OPEX. Even though you have computed your OPEX before, but what we are going to use now, your OPEX shall not be more than 65% of your revenue or your adjustment here. So if it is more, so we are saying allowable cost for OPEX comparison shall be lower of A and B, which is this and this. Now, where CPR limits computed is less than the total allowable OPEX, the balance shall be carried forward. Where CPR limits, this or this, is lower than the total allowable expenses, you carry forward the balance. Excess carry forward can be carried forward into the next year when you want to compute your CPR limit again. The total cost to be allowed as deduction in those subsequent years shall not be in excess or shall not exceed 65% of our gross revenue. So we are saying that the balance that you are unable to recover as a result of the CPR limit shall be carried forward and shall be added to the other expenses in that year and also used for the purpose of computing your CPR limit again. If you got into a live question, I can show you what that does, but we'll soon get to a live question. No worry. Any question? For now, don't worry about the CPR. We'll look at it when we get to the question, live question. So that summary you saw there is what I've explained here. The CPR allowable for deduction for the purpose of ascertaining the profit of the company for the subsequent year shall not be more than the actual cost incurred. Excess costs incurred not allowed for deduction can be carried forward for subsequent year and so on. However, the excess cost shall also be subject to CPR restriction. Upon termination of this outstream operation, the cost that is yet to be deducted shall, because of CPR restriction, will no longer be tax deductible. Examiner asked question with regards to this CPR in the first year they tested petroleum hydrocarbon tax. Look at the question they asked. Look at the question he asked. The examiner said, the adjusted operating cost for CPR limits. Okay, you are required. Look at what in 2020, 2019, or sorry, 2022, maybe November that helps. They said you are required to compute the following and give appropriate comment where applicable. B, the adjusted operating cost for CPR limits and compute and comment on CPR ratio of the company in view of the provision of the Schedule 6 of Petroleum Profit Tax Act, Petroleum Industry Act 2021. So they want to comment on CPR. So when you are given a question on CPR, what you are expected to say is that your CPR shall be capped, your total deductible expenses shall be capped at 65% of the gross revenue, and the following shall be capped at 65% of the gross revenue, and also the allowable expenses shall be for the purpose of CPR shall be all expenses and capital allowance. Your all expenses shall exclude the following: rents, royalty, contribution to fund established by governments, Niger Delta Development Commission, and so on. So you also need to tell the examiner that where the CPR allow for deduction for the purpose of ascertaining the profit of the company for subsequent year shall not be more than the actual cost incurred. The CPR shall not be more than the actual cost incurred. Where there is this fact, the balance shall be carried forward. The excess cost that cannot be relieved as a result of CPR shall be carried forward to the subsequent year for relief. So that is that. The next one is royalty. Now, for our royalty computation, every company that is extracting must pay royalty to government, especially in oil and gas. And for the purpose of paying royalty, according to PIA, there are two ways in which company will be required to pay royalty. They could pay royalty based on their production, and they could also pay royalty based on price of crude oil. Now, when I say based on production, that is in kind, what you have produced, you pay me royalty on that. The next one is based on price, you pay me royalty on. So you are paying royalty in two ways. You are paying based on production. You are also paying based on price. Now, for the purpose of payment on production, we have the table for it. Where the company has an operation in a location that is on onshore, shallow waters, and waters between 100 meters of water depth and 200 meters of water depth, and your production volume per day is greater than 10,000 barrels. Then, if you are an onshore guy, it is 15% that you're going to produce. So your per day production is greater than 10,000 production. So we are saying you are paying $15. Sorry, 15% of that. You are paying 15% of that, of your production. If you are in shallow water, you are paying 12.5% of your fee. You are paying 12.5%. You are paying 12.5% of your production if your production is greater than 10,000. per day. If you are in the water area between 100 meters of water depth and 200 meters of water depth, you are paying 12.5% of your production, provided your production is greater than 10,000. We move to the next one. Number D now. Operations beyond 200 meters of water depth. If you produce between $1 to $50,000, 50,000 barrels a day, your production, you must pay 5% royalty to government. Greater than 50,000 per day, 7.5% you must pay to government as a royalty based on production. If you are on onshore field, shallow waters, including marginal field, where your production is between 1 to 5,000 barrels per day, you are paying 5% to government. If your production goes beyond 5,000 per day to 10,000 per day, and you are also on onshore field, shallow waters, including marginal field, you are paying 7.5% per day. 7.5% of the production. That's what you're going to pay to the government. So government will be looking at it. So cumulatively, so if you have your production per day, so we'll look at the number of days. So we multiply it by, you aggregate it together and multiply by 7%, 7.5%. That's what we are going to pay to government at the fiscal price that you sold that product. The next one is, what if this were to be gas? If it is gas, if the production of natural gas are the one that you exported, it is 5%. Exportation, you pay 5%. Used locally, you pay 2.5%. Now that is that. So we are saying for crude and gas, you are paying different rates depending on your production per day. Depending on your production per day. So that is that. The next one. The next one. If you are with me, I'm with you. The next one is based on price. Based on price. If you sell your crude oil less than $50, you are not paying royalty. Above 50 naira, but less than $100, linear interpolation. If it is above at $100 per barrel, if it is $100 per barrel that you sold your crude oil, you are paying 5% royalty to the government. 5% royalty to the government. If it is above $100, but less than 500 barrels. If it is above $100 to $200 to $150, you are paying a price that you're going to calculate it through interpolation. It is going to be through interpolation. Anything above $150 is going to be 10%. How do you do that, your interpolation? So let's assume we want to calculate above price above $100 to $150. That is price above the price range of above $100 to $150. We are going to use linear interpolation. So that means we don't have any value for 100 above 100 to 150. It is linear interpolation. How do we do that? In doing that, so we identify the price before and after. So what price are we looking for? Let's assume we want to calculate for 100. We want to calculate for $75. The price is $75. And you notice that in this our table, there's nothing like $75 there. There's nothing like $75. We only have 50, 100, and above 150. So that means, and what I want to calculate is between this B. I'm going to use linear interpolation. So when you look at that, it is going to be 100 minus 50. 100 has 5%. 50 has 0. 100 has 5%. 75 that we want to calculate does not have anything. Abi? So I will say, I'll equate it. The 100 minus 50. 100 is 5%. 50 is 0%. 100 is 5%. 75 we don't know. We want to calculate 75, which is going to be Q. So by the time you do that, you will get 2.5%. Do you understand me? Do you understand me?
Yes, sir.
Yeah, so can someone calculate $80 for me? Okay. Let's go again. Look at our table. Our table says if your crude oil is below $50 per barrel, is 0%. That means anything below $50, 0%. So anything above in the range of $50 and $100 is in linear interpolation. At $100, we say 5%. So now want to calculate $75. So we know that $50 is 0. If you sell between $50, it's 0. If you sell above 100 is 5. So let's go and compare it. So I say, I know I have price for 100. I know I have 5 for 50, which is 0. I know I have percentage for 100, but I don't have percentage for 75. So the percentage for 100 is 50. Percentage for 50 is 0. The percentage for 100 is 5 rather. And percentage for 75 is, we don't know. We are looking for that. So what is the actual price, actual percentage going to be for $50, for $75 that you are selling your crude oil? So we need to get the royalty rates. So the royalty will be 2.5%. That's what we are saying. So I am saying that someone should help us calculate for $80. If your crude oil is sold for $80, what is your rates? I'm waiting. How much?
Three.
3. Who is confirming that? What is the answer? What did you get?
Saizini,
Yeah, what did you guys get?
I got three naira.
3%, not naira.
Oh,
3%.
sorry, 3%. Yes, sir.
Okay. Now, what is the penalty for non-compliance if a company fails to comply with the doctrine of reality? Okay. Number one, any sum. So where any reality due and payable under the act is not remitted within 2 months after the month in which the reality is due, the reality shall attract penalty as follows: a sum of 10% of the reality payable shall be added to the reality. In case in foreign currency, you pay at the prevailing LIBOR rate plus 10%. In case it's a Nigerian transaction, it's going to be at NIBOR rate at 10%. Now, for every day in which the failure occurs, the company will pay 10,000 for every day. For the first day, rather, for the first day in which failure occur, and 2 million, 10 million in the first day, 2 million for every of the subsequent days in which the failure continues. So let's go. Illustration 4. We are going to stop on this reality today. And I will have one more class with you. That will be next week, Saturday. And round it up. So illustration next. Using data provided for Pillar N Company Limited, compute the reality payable by the company for 2023 year of assessment. Steps in determining the reality based on price and production. The first one, determine the production per day of the company. This
Sir,
company,
please,
where am I reading?
Yes, sir.
This is where I am. This is where I am. I'm in illustration 4, and I'm here.
All
So
right,
the
thank you.
first thing that you need to do to know the royalty rates that you're going to use, you must first determine the production per day of this company. What are they producing? That's number one. Number two, you must know the area of their operation. Pillar is an onshore operation company. So we said the first thing you do is to determine the production per day. What is your production per day? You told us that the current year production of this company was 7.5 million. What is it per day? Use 365 days to divide it. So if you use 365 days to divide it, you have 20,000 barrels. Now, a company that is doing 20,000 barrels per day and is an onshore company, we have said the company, we said onshore greater than 10,000 per day will be 15%. Abi? So the royalty rate will be 15%. So what I will just do is to say 15% multiply by the value, I'll get my royalty. I'll get my royalty. Shallow water. How much is this company producing per day? This company is producing 95,000, 97,000 per day. We have said for shallow water, your production, if it is greater than 10,000 per day, is 12.5. So 12.5 royalty is what you are going to pay on your revenue. So 12.5. Deep water. Production greater than, we have said beyond 200 meters of water depth. Beyond 200 meters of water depth, that is deep water operation. It is going to be 7.5. We said above 50,000, greater than 50,000 is 7.5. So this guy will be paying 7.5%, and that is that. Now we now said, okay, apart from that, I told you the company usually pays two types of royalty. You pay based on price and you pay based on production. The price at which this crude oil was sold for $125,000. Sorry, $125. And in our table, we do not have $125. We need to go and calculate it. We have 150. We have 100. We have 150, but we don't have 125. So when you look at 125 is in between 100 and 150. Abi? So that is why we are able to use that parameter. When you look at the first one we did, this one, 75 is in between 100 and 50. The same thing, 125 is in between 150 and 100. Extrapolate that, you will get 7.5. So you use 7.5 on all the value, and you have this. So your total royalty paid for the year will be $874 million and $1.1 billion based on production and based on price. The next one. Any question?
Yes, I have a question.
Right.
So from what you said now, is it like one company will be assessed based on production and based on price, and then you add the values together?
No, my dear. I am saying that depending on the area of production of the company. So this is a company now that has 3 areas of production. You understand what I'm saying? So a company could have various areas of production. So I'm saying that this company has 3 areas of production. Do you understand me?
Yes, sir.
Yes.
Sir, I think you didn't get my question. I'm referring to the assessment based on the volume of production and based on the price of
They
crude
will pay
oil.
they will pay the two.
Okay, they will pay. Okay.
They will pay the two.
Thank
It's not, they are paying the two. They will pay based on price. They will pay based on reality. They will pay based on price and based on production.
Oh.
Do you understand me?
Yes, I understand now. Thank you, sir.
They are paying the two, not only one.
Please, sir, the table to the right, the first table to the right, the deep offshore current production 47.2 million. So I'm wondering why the royalty rate applicable is lower, even when the production level is more than that
It's for
of shark
investment.
water.
Government is trying to encourage investments. You understand what I'm saying?
Okay.
Yes, produce more. If you produce more, this is what we are. They are trying to encourage investments in the production of crude oil. That's why they are doing that.
Okay. All right. Thank you, sir.
Any other question? Any other question? Okay. In the absence of no question, we'll go straight to the next one. Now, just like I told you that this company too has the obligation to pay companies income tax liability. Apart from paying hydrocarbon tax, the company has an obligation of paying company income tax liability. So if that's the case, the principle that is applicable here under company will also be applicable under hydrocarbon tax. So let's go ahead. Now, so as you know, the company income tax is one of the tax laws that all companies in Nigeria are expected to pay their tax on their income. So the same thing that is applicable under company income tax has to be applicable here. Now, the only difference here is that there are some expenses that are liable under hydrocarbon tax that will not be applicable, that will not be allowable rather, under company income tax. You get? So, sorry, that are liable under company income tax that will not be allowable under hydrocarbon tax. For example, bank charges is not allowable under hydrocarbon tax. Bad debt is not allowable under hydrocarbon tax. But it is allowable under company income tax. We are going to bring them in under company income tax. So that is that. Now, what are the procedures for filing? Procedure for filing returns. Examiner can ask you this, and you must be able to provide an answer to that. I'll be running off the class in the next 10 minutes, so bear with me. I know you have another class, have you? You have another class after this class?
Yes, sir.
Okay. So procedure for filing returns here, we'll be considering there are two types of return that a petroleum company must file. The first one is the estimated return. The second one is the annual return. The estimated return must be filed within 2 months. We must be filed within 2 months in the current year. So what we are trying to say here is that you have you have a year. During the year, you must file your hydrocarbon tax and your company income tax as applicable under a petroleum company. A petroleum company must do that. So what we are trying to say is that within 2 months from in the current year, the company must tell the tax authority your estimated return, your revenue, your estimated revenue and your estimated expenses based on your budget, and therefore tell them what you are going to be paying on a monthly basis. That is what we call estimated return. So you must file it within 2 months you must file it within 2 months in the current accounting year for the current year. Meanwhile, the other return that the company operating in oil and gas must file is the annual return. The annual return must be filed within 5 months, not later than 5 months, within the first 5 months of the accounting period. So why are we filing within 5 months? We are filing it within 5 months because at that time, the audited financial statement of the company would have been ready. And at that time, the company must file its return. So at that annual return is what we call 13th installment of a company. Now, how does estimated return work? This is how it works. In the first month, I told you the estimated return must be filed within 2 months. After filing estimated returns for 2 months, 1 month after the estimated return has been filed, a company must pay its first estimate based on the estimated return that you have filed to the government. So the first estimate must be paid, second must be paid, third must be paid, fourth must be paid within 1 month after the date of filing the first returns. Within 1 month after the date of filing the what? The first returns. Excuse me. So as I was saying, you must file your returns within 1 month after you must pay your estimate rather after the first month of return. So I said you file your return within 2 months in the current year. Now you must pay your first installment within 1 month after the filing of the returns. So that means your first estimate must be paid on or before 31st of March. On or before 31st of March annually. So in the month, the second estimate must be paid on or before 30th April, and so on and so forth. Now, there could be a situation whereby the company will revise their estimates. Why are you revising estimate? Based on the current price, things has changed. You have now seen things clearer than the way you have seen it in the beginning. So you must also do what we call your revised estimates. Now, when you are revising your estimates, what you will need to do is, initially, let's assume you have said, based on this my estimate, I'm going to pay 90,000. Now you have now revised your estimates. You have now noticed that that 90,000 will be too much. You revise your estimate downward. You could revise downward or upward. So what you will do is that the total estimated returns that you have paid, you will subtract it from the new total returns that you have computed and divide it by the number of months remaining. And you continue to pay. So at the end of the 12th installment, you must have paid all your estimated returns. But because of the audited financial statements is not yet available, you cannot pay your 13th installment. Now, once you now have the audited financial statements, that audited financial statement might now be showing that you are supposed to pay more than what you have estimated. So the difference You are now going to pay it to the what? To the tax authority. To pay the difference to the tax authority. Do you understand me? So that is that. When we come in the next class, which is going to be our last class for this diet, if you have any question that they ask, our last class will be next week. So we can go ahead and. So in the next class with you, we are going to do the calculations. And I want you to go and read this filing of returns and procedure. What are the content of returns? We have done this before. This is audited financial statements, computation of adjusted profit and loss, capital allowance schedule, schedule of the following. You put this amounts, instead of amounts paid, refund or waived or released, computation of actual chargeable profits, and so on and so forth. Evidence of the payment of final installments. So you file it. So that is that. So when we come in the next class, by the grace of God, I want you to go and read all this theory. I just want to go straight to calculation. We are wasting too much time. So I just want to go to calculation straight when I come to your class next week. So we have at least 4 or 5 questions here that we're going to look at in my next class with you. And we'll call it a lecture. Okay. Good day to you. Any question?
Yes, sir.
Yeah.
So I didn't really understand the concept of this annual returns and estimated returns.
So
it's a bit confusing.
Okay, calm down. I said annual returns will be filed within 5 months. Okay, in the current year. And that annual return that you are filing is for the previous year. Do you understand me? Meanwhile, estimated returns is for the current year. That this is what I am going to spend for this year. And that must be filed within 2 months in the current year. Do you understand me? And so I said there are 2 types of return. I said annual return. This must be filed no later than 31st May in the following accounting year within 5 months of the accounting period. So that annual return that you are filing is for this preceding year. You are filing in this year. Meanwhile, estimated return is for this year activity. Annual return is for last year activity that you are filing this year. And for the procedure for computing your estimated returns, that's what I have put here. So let's read it together. On a yearly basis, the petroleum company are required to file an estimated tax return for the year on or before 28th February of every year. That is estimated tax for accounting period to be made within 2 months. Taxes for any accounting period shall be payable in equal installments, together with the final installment, 13 installments. Let's go. We now said the first monthly installment shall be due not later than 1 month, that is in the 3rd month after the filing of return, that is March. We said each remainder on a monthly payment. You have to be paying it on a monthly basis. Each remainder must be paid on a monthly basis. We now said where there is a possibility that you have now understood your business more and there are things has changed, you can revise your estimates. That is the essence of this. So I will now say, in revising my estimates, what is the total estimated tax now? When I'm revising, revised estimated tax now. And what is the tax that I've already paid? So I said, let us assume before now, you were supposed to pay $90,000. So $9,000 divided by 12. You have paid for 2 months. Later, you now found out that no, that $90,000 is not supposed to be up to $90,000. It's supposed to be $70,000. I will now say I've paid 2 months before. So 2 months that I've paid, let's say it's $10,000. Now that I have a revised estimate that is $75,000, I'll come and put $75,000 here. $75,000 here on this estimated tax return minus what I have paid. I have paid $10,000. divided by the number of months left. That is 10 months. Abi? So that balance, that is 65,000 divided by 10, that's 6.5. 6.5, 6.5, 6.5. That is what I'm going to pay till the end of the 12th month. Now, at the end of the 12th month, that means my estimated return, which is now 25,000, is what I have paid, 12 months. Now, my final return, which is the 13th return, will be the, what's it called? Will be the difference of the tax liability that I've paid on my estimates and the actual tax liability that I'm supposed to have paid. So the difference is what I'm now going to pay additional tax liability. So I will remove what I have paid before from the actual that I'm supposed to pay, and I will pay the balance. So that's what I'm saying. So when we come in the next class, we're going to look at illustration on this. That will be my first thing to do with you next class. Good day to you.